Good morning, Harriet.
Well, it's great to have you on the show. It's the last official trading day for the month. January has been a really hard month for most of the markets, a lot of bashing. But taking a look at how this week started, the week started with the Monetary Policy Committee meeting, and of course, investors and the markets waiting for some sort of body movement from the MPC, if you like to put it that way, but that's not what we saw. Now, taking a look at how this week has been, would you say it's been an interesting week, a bearish week, or a bullish week for investors?
I can describe it as being both generally bearish for equities, but very interesting as well, as we saw very high volatility both in the fixed income and the equities market. For the equities market, like you remarked earlier, yesterday the market got a reprieve. Initially, that was on Wednesday. After the MPC came out on Tuesday and announced that the central bank will not be making any more regarding the exchange rates. We saw a number of key tickers, declining on Wednesday due to the high exchange rate uncertainty. But coming to yesterday, because of the cheap market valuation, of course, most of the banking tickers, their price to book ratio have already fallen below 0.2 times for the tier 2 banks. And then for the tier 1 banks that normally command pricing of above 1.0 times. I mean, yesterday, before the market started, they were already below 1.0 times. So yesterday, we saw a number of domestic investors trying to key into the market and take position. And but more generally, what we believe is that the direction of the market going forward will be generally influenced by two factors. Number one, the external environment, looking at the oil price movement, which is a nominal anchor of government revenue in Nigeria, as well as the general economic stability or instability, so to speak. The second factor will be the policy responses to the external shocks we are seeing from the crude oil markets. How the Monetary Policy Committee, as well as the central bank, make adjustments to the changes we are seeing in the external sector, as well as how the fiscal authorities try to restore confidence in the economy and the capital markets. I think those will be the key drivers of the markets going forward. And for the fixed income market, yesterday we also saw that rates for the money market trended downwards. Also for the treasury bills market and the bonds market, yields trading downward because of lots of buying activity. Of course, initially, that was 2 days ago, we saw that liquidity level in the market decline significantly to less than 200 billion naira. And that was due to just a single factor. Most of the banks were trying to subscribe, or rather position ahead of the currency auction by the central bank, which will take place today. So that drained liquidity from the system on Wednesday, and we saw that liquidity level went down to around 200 billion naira. And we saw rates in the money market trending higher. Overnight rates closed at both 7% or so on Wednesday. But yesterday as well, we saw some inflows into the market. There was a net T-bills inflow, about 330 billion naira. And of course, and there are also expectations that the FAC allocation will hit the system, later today. So that sort of, moderated selling activity in the market. And we saw that money market trade declined. Both rates in the T-bills market and the bonds market that's used, they both declined as well. But coming into today, what we expect is that, just before coming for this interview, I got a notification that there'll be an HOMO auction, today. So how much is mopped up by the central bank would influence the liquidity level, and that would, in a way affect the direction of the market. But, going into next week, there will be the banks that were not able to get FX auction at the auction taking place today will be refunded back their money. I'm sure see the FAC allocation coming in either today or on Monday. So that should reduce the liquidity loss in the system. Rather, liquidity, the liquidity in the system. And that probably mean lower rates going into the early trades of next week.
Well, we've already started talking about next week, but let's come back a little bit. Just yesterday, the president told the Nigerian community in Kenya that there are no plans to devalue the naira. Now, this conversation we've had for a very long time. post-MPC or pre-MPC, some analysts had actually speculated that the MPC might make a decision to either shift the corridor around the Naira, where the Naira is at the moment, probably do a readjustment. But now the president has said that there's no adjustment. And in your comments, you said going forward, hopefully policy directions with regards to some very key issues. Now this is a very key issue. The Naira readjustment might begin to give investors more confidence to play in the market. But already, and he's still stating very firmly that there will be no devaluation of the Naira. So in the days ahead, what effect is this going to have on the market? Will we continue to see investors hog the sidelines or dive nose first into the market?
Well, like you mentioned, Harriet, it is both a key issue and a very sensitive one. And it is increasingly becoming a political issue, that issue regarding the exchange rates. I mean, there's been a lot of speculation around initially that the decision on the adjustment or no adjustment now lies above the Monetary Policy Committee and the Central Bank, that it is now increasingly becoming a fiscal issue. And the presidency did not help matters yesterday with that comment. I mean, for most investors, they prefer to see an independent monetary policy regime where monetary policy agencies can take decisions in the best interest of the country and in line with realities. Now, going forward, the important thing to note is this. We are having a fiscal imbalance, a huge fiscal deficit to fund, over 2 trillion naira. I mean, reports in the media now suggest that the deficit may climb up to about 3.3% of GDP. And even beyond that, we're having a balance of payments imbalance as well because of two things. Number one, our current account balance is negative because we are having a decline in our foreign exchange earnings from oil, and because our import bills remains very high. And the second factor is that our capital inflows, both from autonomous sources and also from foreign investors, they seem to have dried up because of the exchange rate uncertainty. So we're having a fiscal deficit, a huge one to fund. We're having a huge balance of payments imbalance. The rational thing to do in such a situation would be to make an adjustment in the currency to try and unlock more government revenue, in Naira terms, number one. And the second thing, to reduce the uncertainty in the domestic economy and financial markets such that we can start having capital inflows into the country and reduce the balance of payment deficits. Now, if that decision had been taken, let's say 6 or 7 months ago, maybe things would have softened a bit. But now, it will take far more than adjustments in the exchange rate to restore confidence to this economy. We need to start seeing probably a change in the exchange rate mechanism itself, rather than having a market determined, solely by the Central Bank of Nigeria, freezing liquidity every day in the interbank market. Maybe a much more market determined, exchange rate mechanism will probably be what will be needed to restore confidence into these markets now.
Okay, so Tola, let's leave it at that for now. That's one takeaway for us for the month of January. Monday is February 1, the start of another new month. Hopefully, we'll be able to chew on it over the weekend and come back to hit this issue as hard as we can. Well, thank you so much for your perspectives this morning.
Thank you for having me, Harriet. Have a great day.
You too.